Keurig Dr. Pepper just posted Q1 2026 earnings, and the market loved every line. The stock jumped more than 7% on enormous volume, revenue beat, EPS beat, and Dr. Pepper keeps gaining share.
This is Charged Alpha, the S&P 500 stock encyclopedia. I am Lana Chen here with Hudson Thomas. Today we go deep on KDP, Keurig Dr. Pepper Incorporated, listed on the NASDAQ.
8 quarters of revenue, EPS actuals versus estimates, margins, cash flow, balance sheet, analyst ratings, peer comparison, segments, and the full bull and bear case. Let us start at the beginning.
Keurig Dr. Pepper traces its roots to two separate American beverage empires. Keurig Green Mountain in single-serve coffee, and Dr. Pepper Snapple in carbonated and non-carbonated drinks, both with decades of brand loyalty.
Those two businesses merged in 2018, backed by JAB Holding Company. Keurig brought its at-home brewer platform and distribution muscle. Dr. Pepper brought fountain accounts, CSD brands, and broad national retail reach.
The combined company now holds over 30 beverage brands spanning coffee, carbonated soft drinks, non-carbonated beverages, and premium water, giving KDP shelf presence across essentially every major drink category in the U.S.
KDP is headquartered in Frisco, Texas, with significant operations in Burlington, Massachusetts. Approximately 29,000 employees work in manufacturing, sales, distribution, and corporate functions across the U.S. and select international markets.
The four segments are coffee systems, packaged beverages, beverage concentrates, and Latin America beverages. Each has a distinct revenue scale, margin profile, and growth stage, and each plays a different role in the overall portfolio story.
Coffee systems is the Keurig brewer and K-Cup pod ecosystem. Packaged beverages covers ready-to-drink cans and bottles. Beverage concentrates is the fountain and syrup business. Latin America beverages covers Mexico-focused international operations.
CEO Timothy Cofer has led the company since 2023, having served as Chief Operating Officer before stepping into the top role. His background includes over 20 years at Mondelez International in senior global positions.
Cofer's 4 priorities: accelerate Dr. Pepper's CSD market share, stabilize and innovate the Keurig platform, reduce the merger debt load systematically, and expand KDP's limited international presence into new distribution markets.
The brand roster includes Dr. Pepper, 7UP, Canada Dry, Snapple, Bai, Core Water, Evian, Hawaiian Punch, A&W, Mott's, Vita Coco, Green Mountain, and Keurig. Few beverage companies can match that multi-category shelf coverage.
The merger created real distribution scale. Keurig's direct store delivery network and Dr. Pepper's fountain infrastructure together reach more retail contact points than either company had independently, a structural competitive advantage.
JAB Holding Company remains the controlling strategic shareholder and has held its position since the 2018 merger. That ownership concentration aligns JAB's long-term beverage interests with KDP shareholders, a stabilizing force at the top of the capital structure.
Revenue trend: 8 quarters beginning Q2 2024. First reading $3.92 billion, then Q3 2024 at $3.89 billion. Q4 2024 stepped up to $4.07 billion as holiday coffee pod gifting boosted the coffee systems segment in December.
Q1 2025 pulled back seasonally to $3.64 billion. The coffee pod business slows naturally as temperatures warm. That is a predictable seasonal pattern, not a sign of share loss or any fundamental change in business trajectory.
Then the year accelerated. Q2 2025 was $4.16 billion. Q3 2025 grew to $4.31 billion. Q4 2025 closed at $4.50 billion, each quarter beating its prior year equivalent and building momentum into 2026.
Q1 2026 delivered $3.98 billion, 9.4% year-over-year growth versus Q1 2025. The consensus estimate was $3.84 billion. KDP beat by approximately $140 million, a clean, credible outperformance on the top line.
2 forces drove the beat. First, pricing power in carbonated soft drinks. Second, volume recovery in packaged beverages. Coffee systems remain the drag as K-Cup pod volumes plateau in the maturing U.S. single-serve coffee market.
Full year 2026 forward revenue averages $26.1 billion across 10 analysts. The range is tight, $26.0 to $26.2 billion. That figure reflects the fully consolidated entity, including all distribution and licensing arrangements.
The revenue run rate matters. Q1 is seasonally softest due to coffee. KDP needs to sustain 9% growth through Q2 and Q3 to track consensus, and the Dr. Pepper share gain trend gives real runway for that.
Dr. Pepper's share gains are the standout story within the packaged beverages segment. The brand has been taking dollar and volume share from both Pepsi and Coke in grocery and convenience, a trend running for multiple consecutive quarters now.
Dr. Pepper's consistency is worth underlining. The brand has been gaining share from both Pepsi and Coke, a trend running for multiple consecutive quarters and showing no signs of reversal in the most recent data available.
The Q1 2026 beat did not happen in a vacuum. It reflects deliberate pricing strategy, disciplined SG&A management, and a distribution system that is executing consistently across grocery, convenience, and food service channels nationwide. EPS history. Q2 2024, actual 38 cents, estimated 37. Q3 2024, actual 45 cents, estimated 44. Both were 1-cent beats, clean, steady execution throughout the first half of calendar year 2024.
Q4 2024 was the shock quarter. Actual EPS was negative 11 cents against a 42-cent estimate. Large impairment charges on the Keurig platform drove that miss. The core business held up, but the headline was jarring for shareholders.
Q1 2025 reset the narrative at 38 cents actual versus 37 estimated. Q2 2025, 40 versus 39. Q3 2025, 54 versus 53.7. Q4 2025, 60 cents versus 58.9. 4 consecutive beats heading into Q1 2026.
Q1 2026 extended the streak. 39 cents actual versus 37.2 estimated, a 4.7% positive surprise. Combined with the revenue beat that drove the 7.5% stock move on April 23rd. The market was clearly underpositioned.
So what does the forward earnings picture look like? 8 analysts project fiscal 2026 EPS at $2.26 on average. The range is $2.15 to $2.29. That is significant acceleration from the approximately $1.47 in trailing EPS.
The forward EPS projection for fiscal 2026 at $2.26 reflects 3 independently positive drivers: Dr. Pepper CSD pricing gains, strong beverage concentrates execution, and declining interest expense as the merger debt load continues to shrink quarter by quarter.
Looking further out, 2027 consensus EPS averages $2.48 per share. For 2028, it reaches $2.59. 9 analysts cover the 2027 estimate. That 3-year earnings growth path is the backbone of the multi-year re-rating thesis for long-term holders.
The forward EPS projection for 2028 at $2.59 implies roughly 76% cumulative EPS growth from today's trailing base over 3 years. That pace of growth supports multiple expansion in any interest rate environment, moderately constructive for consumer staples.
The analyst estimate dispersion for 2026 EPS is narrow, $2.15 to $2.29, reflecting high consensus confidence. Tight ranges on forward estimates generally indicate that the investment community sees the earnings path as clear and executable without major surprises. Margins. Trailing 12-month gross margin is 53.8%. Strong for a company manufacturing beverages at scale while operating a brewer hardware business and maintaining a national distribution network across multiple retail channels.
EBITDA margin is 21.8% trailing. Operating margin runs at 21.3%. Net profit margin is 10.8%. Solid numbers for the category, though the merger debt compresses net margin relative to the strong gross and operating line performance.
In Q1 2026, revenue $3.98 billion, gross profit $2.1 billion, gross margin 52.8%. SG&A was $1.34 billion. Operating income was $756 million. Net income came in at $270 million.
The primary margin headwind is interest expense. KDP paid $281 million in net interest in Q1 2026 alone, over $1 billion annualized going straight to debt service rather than to shareholders or back into the operating business.
The deleveraging to margin link is direct. Each $1 billion of debt repaid saves 40 to 50 million in annual interest. That savings flows straight to pre-tax income, making deleveraging simultaneously a balance sheet and a margin expansion program.
As interest expense falls, net margin expands without requiring any improvement in gross or operating performance. That independent earnings growth driver is the most powerful and underappreciated element of the KDP thesis for investors with a multi-year horizon.
To frame the magnitude, KDP's gross margin of 53.8% is genuinely strong. The gap between gross margin and net margin reflects almost entirely the merger debt load, not operational weakness. Fixing the balance sheet fixes the earnings power. Cash flow. Q1 2026 operating cash flow was $281 million. Free cash flow was $165 million after $116 million in capital expenditure. Q1 is seasonally weak as working capital builds ahead of summer beverage demand.
The trailing four-quarter view is more complete. Q2 2025 OCF was $431 million. Q3 2025 was $639 million. Q4 2025 was $712 million. FCF for those quarters, $323, $527, and $566 million respectively.
Free cash flow conversion runs approximately 77% of operating cash flow trailing. CapEx averages around $120 million per quarter, roughly 3% of quarterly revenue. For KDP's scale, that is a lean and efficient capital program.
After the quarterly dividend payment of roughly $310 million, the remaining free cash flow goes toward debt reduction. That arithmetic is working. Net debt has been declining from the post-merger peak with each quarter of consistent execution.
The CapEx discipline deserves emphasis. KDP is not a capital-intensive business, despite its manufacturing and distribution scale. Low CapEx as a percentage of revenue is a structural advantage that separates beverage franchise models from more asset-heavy consumer goods competitors.
Free cash flow is growing. Q1 is always the seasonal trough. The trajectory from Q2 through Q4 in 2025, $323, $527, $566 million, shows that the business generates meaningful cash when operating at full seasonal intensity.
Balance sheet as of March 31, 2026. Total assets are $73.1 billion. Total liabilities are $39.5 billion. Total equity, including minority interest, is $29.2 billion. Cash on hand is $898 million.
Total debt is $25.7 billion. Net debt, total debt minus cash, is $24.8 billion. Long-term debt is $20.9 billion, and short-term debt is $4.8 billion. The debt structure reflects the legacy 2018 merger financing.
Goodwill and intangibles total $43.9 billion, roughly 60% of total assets. That is the 2018 merger premium for the Keurig and Dr. Pepper franchises. It weighs on tangible book value but reflects genuine economic franchise worth.
Net debt to EBITDA was approximately 3.6 times on a full year 2025 basis. Management targets below 3 times. Debt to equity is roughly 1.0. Interest coverage at approximately 4 times is adequate, but leaves limited buffer for any earnings disappointment.
The goodwill and intangibles number deserves context. $43.9 billion is large, but it represents real franchise value. The Dr. Pepper brand commands premium shelf positioning and consumer loyalty that cash on hand cannot replicate. It is not phantom value, capital allocation. KDP pays 92 cents per share annually, yielding approximately 3.2%. The trailing payout ratio is 51%. Well covered and leaving room for dividend growth as EPS expands toward the 2026 and 2027 consensus targets.
Buybacks are minimal and deliberately so. $9 million in all of Q2 2025. Management has been explicit. Excess free cash flow beyond the dividend goes to debt paydown. At 3.6 times leverage, debt reduction first is the right discipline.
Successful deleveraging creates real optionality. At 3 times leverage, KDP can pursue acquisitions, accelerate buybacks, or grow the dividend. None of those options is available today without balance sheet stress. Patience is the price of that future strategic flexibility.
Free cash flow yield is approximately 3.96% trailing and improves as interest expense falls. The compounding impact of lower debt service funding, higher free cash flow, is a value creation mechanism not yet fully visible in current market pricing.
Analyst ratings. The buy camp is well populated. JP Morgan overweight, Wells Fargo overweight, Citigroup buy, UBS buy, Piper Sandler overweight, RBC outperform, Bank of America buy. 7 firms with explicit bullish ratings heading into Q1 earnings.
Morgan Stanley upgraded to overweight in April 2025, a significant shift. Barclays at equal weight, Deutsche Bank at hold, Goldman at neutral, TD Cowen at hold. Jefferies downgraded from buy to hold in December 2025, citing coffee recovery concerns.
BNP Paribas upgraded from underperformed to neutral on April 22, 2026, one day before Q1 earnings were released. That timing proved prescient. Consensus price target averages approximately $34 per share, roughly 19% upside from current levels.
Post the Q1 beat, expect upward price target revisions across coverage. The 7.5% stock move on earnings day reflects a market that was underpositioned. Positive analyst momentum following a meaningful beat creates a near-term technical tailwind for the stock.
8 buy ratings and 0 sells is unusual for a stock at a discount to Staples peers. That analyst alignment reflects broad agreement that the deleveraging story is intact and the valuation gap is real rather than structurally justified. Valuation. KDP trades at 21.2 times trailing earnings. Price to sales is 2.3 times. Price to book is 1.5 times. EV to EBITDA is approximately 17.2 times trailing, all below consumer staples sector averages.
The forward multiple is more instructive. Applying the 2026 consensus EPS to today's price gives a forward PE of roughly 12.6 times. That is below Coca-Cola near 22, PepsiCo near 18, and Monster Beverage at 27 times.
The leverage discount explains most of that gap. Investors apply a risk premium above 3 times net debt to EBITDA. As KDP deleverages toward its target, that premium shrinks, the multiple expands, and the stock moves toward analyst price targets.
The re-rating math is straightforward. A move from 12.6 to 15 times 2026 EPS of $2.26 implies approximately $33 to $34, squarely where the analyst average target sits. The thesis is quantified and earnings momentum supports it.
Peer comparison, starting with trailing PE, KDP at 21.2 times, PepsiCo at 18.5, Coca-Cola at 22.4, Monster Beverage at 27.1, Boston Beer at 35.8. KDP sits in the middle of this peer group.
Price to sales, KDP at 2.3 times, PepsiCo at 1.9, Coca-Cola at 6.2, Monster at 5.4, Boston Beer at 1.7. KDP is not expensive on that metric versus its rivals in this peer comparison, competitive with large diversified staples.
Revenue growth year over year. KDP at 9.4% in Q1 2026, PepsiCo at 1.2, Coca-Cola at 8, Monster at 6.3, Boston Beer at negative 2.1. KDP leads the peer set on revenue growth in the most recent comparable period.
That revenue growth leadership is the most underappreciated data point in the KDP story. Paying 12.6 times forward earnings for the fastest grower in the peer set with a 3% yield is a combination the market has not priced.
Segment breakdown. Coffee Systems is roughly 28% of revenue, the Keurig brewer and K-Cup pod business. Pod volume growth has plateaued as the U.S. single-serve market matures. This is the primary structural skepticism weighing on KDP's valuation multiple.
Innovation is the key coffee lever. KDP is developing cold brew and premium pod formats. A credible coffee reinvention, if delivered, could re-rate the stock as a standalone catalyst independent of the deleveraging or CSD share gain thesis.
Packaged beverages is roughly 40% of revenue, the portfolio growth engine. Ready-to-drink Dr. Pepper, Canada Dry, Snapple, and Core Water in cans and bottles. Dr. Pepper has been gaining dollar and volume share from both PepsiCo and Coca-Cola.
Beverage concentrates is roughly 24% of revenue and the highest margin segment. Syrup and concentrate for fountain operators and food service chains. High switching costs and recurring revenue make this the best return segment in the KDP portfolio.
Latin America beverages is roughly 8% of revenue, Penafiel sparkling water and Clamato in Mexico and regional markets. This is KDP's primary international exposure today and the strategic foundation for management's longer-term global distribution growth ambitions.
The segment mix creates natural diversification. When Coffee Systems faces headwinds, the packaged beverages and beverage concentrates segments provide offsetting tailwinds. That natural hedging across different beverage categories is a structural advantage of the merged entity model.
Beverage concentrates deserves attention as a value driver. It is the smallest segment by revenue, but likely the highest by margin. Fountain syrup economics are sticky. Once a restaurant chain selects Dr. Pepper concentrate, switching costs make displacement unlikely. Bull case 1. Dr. Pepper is winning in carbonated soft drinks. Share gains over 8 consecutive quarters versus Pepsi and Coke. The 3-brand CSD category is now more balanced, and Dr. Pepper is the primary beneficiary of that shift.
Bull case 2. The deleveraging trajectory is credible, net debt declining from peak merger levels. As leverage approaches 3 times EBITDA, the multiple discount closes and the stock re-rates, a defined catalyst with a clear numerical trigger.
Bull case 3. International expansion is multi-year upside essentially free in the current valuation. KDP has minimal non-US revenue versus KO and PEP. Even modest international distribution wins open incremental revenue streams not yet embedded in any consensus analyst estimates.
Bull case 4. Income appeal with a payout ratio that has room to grow. A 3.2% yield attracts income-oriented investors who provide natural floor support for the stock, a self-reinforcing dynamic that benefits long-term holders in the position.
Bear case 1. Keurig coffee faces a structural headwind. K-Cup pod volumes have stalled. Premium espresso machines and cold brew are capturing wallet share. KDP needs a coffee reinvention and has not yet delivered one that moves the volume needle.
Bear case 2. The debt load constrains strategic flexibility. $24.8 billion in net debt limits acquisitions and buybacks. If EBITDA disappoints for even 1 or 2 quarters, the deleveraging timeline extends, the risk premium persists, and the discount deepens.
Bear case 3. Input cost volatility is real. Coffee beans, aluminum, PET resin, and diesel can spike simultaneously. Margins compress faster than pricing recovers. A multi-quarter squeeze that damages the deleveraging pace and slows the re-rating story.
Bear case 4. Private label pressure is growing. Retailers are expanding store-brand coffee pods and carbonated soft drinks. As consumers trade down, KDP's branded products face volume and margin risk from below, underpriced in the current forward multiple.
Net assessment. KDP is a beverage franchise with a clear deleveraging path, a CSD brand gaining share, and a dividend backed by durable cash flow. At 12.6 times forward earnings, the risk-reward skews toward the upside as leverage normalizes.
Buffett wrote, "The best business is a royalty on the growth of others, requiring little capital itself." KDP's brands aspire to that royalty model. The merger debt is the gap between where KDP stands and where it is headed.
This podcast is for informational and entertainment purposes only and does not constitute financial advice. The information presented reflects data available at the time of recording and may not be current. Always consult a qualified financial advisor before making any investment decisions. Charged Alpha and its hosts may hold positions in securities discussed. Past performance is not indicative of future results.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street